So in year 0, if I purchase something, I've got my down payment in year 0. So this is going to equal my cost multiplied by my percent down. My depreciation, well, let's just go ahead and do all the financing. Then the next year, I need my principal portion of the payment. And so that's going to be equals PPMT, the principal portion of the payment. The rate is my finance rate, 2.9%, comma. The period that I'm in is the year that it is, comma. The total number of periods is the years financed, and that should be an F4. Coming back, my rate should also be an F4. Okay, so the number we had the period that we're in, the total number of periods, comma, and now my present value is the original cost, F4, multiplied by times opening parentheses 1 minus the percent down, F4. Close parentheses. So that's my present value. We don't have a future value, so I can just do another parenthesis to close it. And then it's displaying as a negative, so I put in my negative sign there to display it as a positive. And then I drag it down, and you'll notice I've got some issues here. Because I told it I was only going to do 4 payments, so it doesn't know how to calculate a 5th payment, 6th, 7th, 8th, 9th, 10th, 11th. And so the way that we fix this is, again, with that if statement. We just put it around. So if, opening parentheses, and this is our test if it's true. And so as what we want is if B7, the years financed, and that's an F4, is greater than or equal to the year that it is, A14, comma, then it's going to include this present value or of the principal, or I mean the principal value of the payment, comma, and if it's not true, then we want to put in a 0 and then close our parentheses. And now I'm going to drag that all the way down, and you can see now that it did our 4 payments there. To do our interest, you can retype it in just the same way as we did the principal, but we need IPMT. I copied it over, and now I'm going to fix it. So as you can see, this B14 should have been A14. And so all I've got to do, but when I copied it over, it turned it into a B. So I just make that an A. And that's in 2 places. And then the other thing that I need to do is, instead of PPMT, I want an IPMT so I can do the interest part of it. And that fixes it. And so now I've got my interest, and I can copy that all the way down. You can see that it also copied that line there with it. And so is what you can do to get rid of that line is just go here, borders, no border. Then we can do no border, then bottom border. No, it's all fixed. Okay, so we've got our down payment and our principal. Down here, we could put in a total here, but if you just highlight all of those cells and come observe in the corner, it should say $37,500 and be equal to the original cost. Because between the down payment and the principal payments, we need to pay for the entire asset, the $37,500. And in this case it does, so we did it correctly. Depreciation, again, if we buy it in 2011, in December, we can take our first depreciation payment in 2011, and so it's going to be equal to the original cost, F4, multiplied by the depreciation rate. Enter, and then just copy that all the way down. These are in green, and so I've got them in here for the correct percentages for the loader. But if you have other assets that have different depreciation rates, you'll have to type those in. And so we've got that. The other thing we have is our residual value, this $26,000, and we want it to be here in year 4. And so the way that we do that is we put an if statement around that too. And so we say if, in this case, the year that we are is equal to the year that it's sold, then put in the salvage value, else 0. And we want this F5 to have an F4 around it because we don't want that to move. And then also the H5 is the same way, an F4 around it. So we get those dollar signs there. And then you drag it down. And you can see that here in year 4, that's where it's putting it, just like it should be. Now we have to have a tax credit, and the tax credits, we have to have how much we're saving in taxes multiplied by the tax rate. And in the year that we have our residual value, though, we're going to have to pay taxes on that residual value, and so that's going to be a little bit different. So it's kind of a long formula, but we'll just go for it. So it's equal if, opening parentheses, or sorry, we don't need to do the if statement first. So opening parentheses, because what we want inside these parentheses is our total taxable income, or total net taxable deductions, and then we're going to multiply that by the tax rate. So like normal, the previous year's interest plus its depreciation is going to be tax deductible. But then we're going to have to pay taxes on the residual amount, but only if it's there. And if it's there, then we want to subtract any remaining basis that we might have in it. So we're going to do minus an if statement. And our argument is looking at if this previous amount, I-13, is positive, greater than 0, then we know we have a residual value in that year, and then we've got to figure out how much we would be paying taxes on. And that's going to be equal to an opening parentheses, and it's I-13, the original, or the residual value, minus any basis we have. And the basis, we want to opening parentheses again, is going to be our original cost, and we want an F4 on that, minus the sum, opening parentheses, of all this depreciation. And do an F4 there. And then we've got to close our parentheses for the sum, close our parentheses for the basis, close our parentheses for this residual value minus the basis. And so that's going to be 3, comma, and then this is what our if statement does if this isn't true, and if it's not a residual value, then year that we sell something, then we put in a 0. And then we've got to close our parenthesis for our if statement and close our parenthesis for the whole amount that would be our net deductions. And then we want to multiply that by the tax rate. And do an F4 for the tax rate. And so it's a little bit hairy, but it is, the cell references and everything are given to you on your handout. So if, let's see, what did I do here? Oh yeah, I've got it right. Sorry. So it's 1205, and then I copy that down, And so you can see my tax credit here the year after I have that residual value is a negative amount because I'm actually going to have to pay taxes the year that I sell it. And then my net cash flow is just equal to everything that's a cash. So it's the down payment plus the interest plus I don't pay cash for depreciation. Sorry, but it's going to be I subtract off because I get cash from the residual value and minus the tax credit because that provides me with it's a return. Copy that down. And then my net present cost is equal to NPV, opening parentheses, my rate, which is the discount rate, 7%, comma, year one amounts through the end, close parentheses, plus year zero's amount. So in this case, it was much, much cheaper for what we were planning on to purchase it, because that has a net cost to us in today's dollars of $10,263, versus leasing it cost $21,244. But like I said, this really depends on just what the current market is and what the assumptions are, and lease rates versus the values to sell it and the financing terms and all sorts of things. So it's really just something that you have to calculate every so often because these relationships will switch under other conditions. And that's it for our lease versus purchase.